Obviously introduce myself, I'm Tom Sieber, Deputy Editor at Shares, but I'll go along and get the guys to introduce themselves and what their background is and what expertise they're bringing to the table.
So just very quickly, Simon Glover. I'm CEO of a company called ITI Group. My background was in hedge funds, but now specialist on ETFs, which we use primarily for their diversification benefits. So it's a great panel to be on.
Thank you, Simon. And Vivian?
My name is Vivian Slattery. I'm a director of my company, Monetary Solutions. We're independent financial advisors, and actually all the advisors in the company are female.
Andrew Keegan, I'm a portfolio strategist with BlackRock within our multi-asset business. We manage about $300 billion in multi-asset assets as part of a $5 trillion business.
Great. Just to start off with, I'll ask a couple of questions just to get us cracking. What I'm hoping is there'll be some questions from you guys in the room, so we'll turn it over to you sort of after I've asked a couple of questions. Obviously, the title of the discussion is how to build a diversified portfolio in the new post-Brexit world. So maybe as a starting point, I'll just ask, and you can jump in, guys, if you think you've got a response on this, but has Brexit made any difference in terms of how you approach constructing a diversified portfolio? I don't know who wants to go for that first. Simon, do you want to?
Yeah, I think the comment really would be the first comment on what happened over Brexit, which for those who weren't following it very, very closely was really a 2-day event. This was a great stress test for your portfolios. So it really is worth going back and having a look at those statements over those critical Friday, Monday, Tuesday, because if you recall, the stock markets were down some 10% overnight, or when we woke up in the morning. By the end of the day, they were only down 2%, and I think 2 or 3 days later they were up. However, if there was volatility, if you did suffer some major account value changes over those 2 or 3 days, what a great stress test. Have a look at it, talk to your financial advisor and say, listen, we've got a problem here, because that shouldn't really have happened in a well-diversified portfolio.
Yeah, I know, Vivian, we were talking before and you mentioned that you saw some quite extraordinary moves in terms of clients' portfolios kind of around Brexit. So perhaps you could touch on that a little bit.
I think when everybody looks, I mean, generally speaking, when people look at or talk about markets, we all concentrate on the UK market and what's happened, post-Brexit with the UK market. And I think some of the other markets have been very interesting. Gilts and fixed interest. It's very interesting to look at your own portfolio and to actually work out what has gone up in that portfolio, and what percentage changes, because some of the gains, on portfolios are not what people were expecting by any stretch of the imagination. I don't think so. But no, it's been very interesting. But I think it's post-Brexit. We're the only start of the post-Brexit. There's a very long journey to go ahead, and what will happen, nobody knows.
What initial lessons do you think we can draw, though, Andrew, in terms of?
Well, I think we all need to realise that we have to try to expect the unexpected. In the hierarchy of certainty, I don't think Brexit, for a lot of people, was, maybe for some they expected it to happen, wanted it to happen, but for a lot of people there was an expectation that it wouldn't happen.
Yeah.
And to my fellow panellists, in terms of when you look at your portfolios and you look at the returns you've seen, try to look at them with the lens of actually where did those returns come from, and how much did the weakening in sterling actually contribute to that. If you look at over the last several years, take the equity markets globally, it didn't really matter what you bought, it went up. And even if the underlying market went down, it went up because of the weakness in sterling. And the potential implications that's going to have forward-looking. Yes, you had a nice injection over the last couple of weeks and months, but is that going to continue, and what drove that?
Great. At this point, if anybody has got a question in the room, I'd like to open it up. So if anybody wants to stick their hand up, we have got microphones. So yes, the gentleman just in the middle there.
Yeah, just one question. I mean, everyone keeps going about buying gilts or government debt. as part of a diversified portfolio. But could you explain to me, I'm a bit of a loss to understand, why, I understand there's $11 trillion of negative equity, negative yield in bonds, but if financial institutions and everybody keeps buying them, why on earth would you buy something that's sure to lose you money?
Well, it's about insurance, right? We all pay insurance for safety. And when you're exposed to the equity markets for growth, you need something that either historically or you think will try to offset. In my training, I never thought about buying fixed income for growth. It was stability and maybe hopefully a coupon. And that's the role that fixed income plays in a portfolio. It has been challenged. The correlation or the movements of fixed income and equities historically 10 years ago would offset each other. Now we know that that's actually changed over the last couple of years. If equities were to move down, fixed income was moving more and less in the same direction. So I agree that fixed income is not playing the same role it used to, and you have to look beyond gilts. You have to look on a much more global basis. You have to look to the US, for example. You have to look to other parts of the world where you can still get returns and stability and diversification within fixed income. So we're thinking, there's a role for, at times, government bonds, but perhaps looking at things like emerging market bonds, where the impact of the rising dollar or rising interest rates in the US won't have as much of an impact. So we really have to think outside of the traditional fixed income toolbox and from a strategy perspective as well.
Guys, have you got any thoughts on that? I mean, there's obviously been a long bull run in bonds that maybe has made diversification more difficult. What do you think?
I'm just going to throw things a little bit open here because there's, one of the specialist investors in the world is the Yale Endowment Fund. For the last 20 years, they've returned 13.7% year on year, or on average over that period. They've taken their endowment fund from 4 billion to 24 billion over that period, plus paying a lot of scholarships and fees and expenses along the way. So by any measure, that's a great performance. So I just happen to have with me their asset allocation target for 2016, and they've only got 4% in bonds. So I don't know if that helps at all in answering the question.
Yeah, no, that's interesting. What about you, Vivian? Have you got thoughts on sort of bonds and?
Well, it's very similar to what everybody else says, that you've just got to have a mixture of everything because nobody knows what's going to go up next. That everybody will sort of say, don't invest in this, don't invest in that, and, or you should invest in this. But if you hold a little bit in everything, at least you know that you've got much more of a chance of something going up.
We got any more questions from the room? We've got one at the back there, I think.
My question is about equities post-Brexit. It's been really interesting since the referendum vote to see that the high performers in the equity markets have been those that generate their income from overseas, and they've benefited from the action of the pound. What do you guys see as strong sectors going forward? Because what I would suggest is that these same companies that have done well in the last 2 or 3 months may suffer through the trade negotiations going forward in Article 50. So strong sectors in equities over the next 2 years. Where do you see the high performers?
Who's prepared to nail their colours to the mast first? Who wants to take that one?
I would normally offer to the ladies first, but you're called.
I honestly believe in a diverse portfolio. Nobody knows the answer to that question. As I say, the best thing to do is to have a diverse portfolio so that, hopefully you pick, one of the stronger performers.
I'll put my hat in here. I think, there's a lot of challenge, and your base case should be to try to diversify. But if you are looking for themes, you're looking for things where you want to place a small bit of money as a speculative investment or a diversifying investment, you've got to look at the big trends in the combination of things like healthcare, technology, themes that we think, the digitalization, how you can play those types of themes. I don't believe that you should be putting all your money in single 1 or 2 companies. I think you still need to spread your investments across that type of sector exposure and then hold that within a commensurate level of percentage within a portfolio. But tech, healthcare, those things that are going to benefit from innovation and even other aspects of sectors as well that will benefit over time on a global basis as we see trends moving.
I mean, in terms of diversification, do you feel you can ever have too much diversification? Is that ever the case?
Statistically,
Can a portfolio be too
yes,
yeah.
you can. If you think about an efficient frontier, at some point in time, adding more assets doesn't actually reduce risk or enhance returns in any way. Whether you take a risk parity approach, and we can get very complex in this type of stuff, but if you keep it in simple terms, a combination of equities and bonds, call it a 60-40, 90% of the risk of that is equities. So you've got to really try to diversify that away, but at a certain point, any additional independent decorrelation is not going to add any value. So you've got to try to manage that. And to my point earlier, it's becoming much, much harder. We as an investment industry and investors and consumers need to recognize, yes, there's great opportunities now in the market, evolution of ETFs, you can build very diverse portfolios very quickly. But from an investor perspective, I'm quite challenged or quite scared about the levels of decorrelation that I used to rely on that I can't anymore. You've got to run very fast just to stand still.
Absolutely. I mean, I was going to sort of maybe move to that next just quickly. So, I mean, I could open this up to you guys as well, but what are the genuinely kind of uncorrelated asset classes out there that you can use to achieve genuine diversification? Because obviously you talked about 2008 in your presentation this morning, Vivian, and I mean, like you said, everything went down at that point. So where can you find sort of genuinely uncorrelated assets?
Sorry to go back to my Yale example, but it's just interesting to note that their 2016 allocation to US equities is just 4%. In total, with foreign equity exposure, their total portfolio has an 18% exposure. Now, I'm not suggesting everyone's portfolio reflects that immediately, but it is an interesting point. And so what are they investing in? Their biggest allocation is to what they call absolute return products. Maybe it's too lengthy a subject to go into what are they, but obviously they would include things like hedge funds and various other alternative investments. iShares happen to have a great absolute return ETF. Not giving you a plug, but
my colleague from iShares is the back of the room. He'll hear that.
But these products are out there. In fact, everything that's in the Yale Endowment Plan strategic allocation, which includes exposure to private equity and real estate, etc., is all available through an ETF. So effectively, you can replicate these very diverse, very balanced portfolios, just picking out the correct ETFs to build.
Have you got any thoughts on that, Vivian, before we move to the next question? Or
Very much what they said.
sure.
I'll throw out commodities as one, only because I like a lot of people will challenge this, and that's fine. That's fine. But if you think about commodities, not as a gold or oil, but in terms of the underlying individual commodities, call it grain, call it other types of exposures, the risk factors of those are not commensurate with the risk factor of the equity market or the bond market. So not suggesting that's the right investment to be buying, but from a technical perspective, the fact that the weather and wars can drive the risk premium of these exposures, that gives you something that is independent to an equity or bond market. So again, it echoes with the story of you just need to diversify across these things.
Absolutely.
I would just add to that obviously, over the last 4 or 5 years, commodities have taken a tremendous beating.
Yeah.
So in terms of a value proposition, who knows, but they're way down from where they were,
Absolutely.
and the case is still there for them.
Yeah, absolutely. Right, have we got any more questions from the room? I think we've got a question at the front here, just front and to the right.
Thanks. Just going back to the fixed income and the use of the word bonds, people very often when they're talking about bonds, you figure out that they're actually talking about government bonds. Can the panel members please distinguish between the role of government bonds and, on the one hand, and corporate bonds on the other, in a diversified portfolio?
Yeah, that's an
please?
interesting point. I don't know who wants to pick that up.
I mean, I can please add in as well, but I mean, in a very traditional sense, government bonds play the role of stability, and historically that was stability in you could, take a reasonable level of coupon, which in effectively was risk-free from a default perspective. Investment grade credit, as we would term it, is more of a riskier type of fixed income asset. Obviously, there is default risk in terms of you're investing in the debt of companies. On the back of that, of course, we had the more speculative of high yield, which are investment grade, which is known as high yield, which again has a more of an equity-like risk characteristic, high probability of defaults at certain times and period. If you're investing in these types of companies, they are, tend to be very small companies. They go through funding issues. You can of course invest in them through active strategies. You can of course invest in them in a diversified basket through an ETF. But you have to recognize it is about diversification within fixed income, but you're taking equity-like risk in doing so. If you're investing in the US market, for example, of course you can invest in the S&P 500. You can also invest in US high yield as a proxy on growth in the US market as well. Less overall risk and volatility in equities, but still taking equity risk. Emerging, in terms of relative to developed markets, those with long enough investing memories will remember defaults in emerging market economies and defaulting on debt, whether it's like Russia. Emerging market economies are in a much stronger position now than they have been in the past, and they have weathered relatively well various storms. And so an element of emerging market debt, be it dollar-denominated investment or investment grade, brings an element of diversification to the fixed income part of your portfolio. Does that answer your question?
Anybody else want to come in on that? Or Andrew, I think Andrew covered it pretty well. So have we got any other questions from the room? I think we've got one sort of in the middle and to the left-hand side, just over there. Thank you.
I just wondered if you could just summarise your overall view on the valuations in equity markets, or particularly developed equity markets now. We've had a phenomenally long bull run, far since the financial crisis. It's far exceeded the length of the average bull run, and obviously left stocks and bonds looking very expensive. And the performance of the major economies has not kept up with the performance of stock markets. So unless we get some sort of recovery in economies that filters down to earnings, the situation's only going to get worse. And yet we've now started to see several quarters of negative growth in corporate earnings in the States. There's now the risk, according to some economists, of a recession in the UK, which may filter over into Europe, which gives even less support for earnings and valuations. So is it time that should we all be buying absolute return funds, which seem to have been one of the most popular sellers this year? Or do we just look for other alternative asset classes like gold or...
Great, that's a good question. So, I mean, maybe each of you could take it in turn, but Simon, if you wanted to sort of address some of those points.
It's pure conjecture, it's not my area of expertise, but I tend to agree with the sentiment of the question. This goes back to 1982 when Greenberg started, the then Fed chairman, started effectively adapting US monetary policy to the stock market. And ever since then, we've been in a strange and weird and wonderful world. The amount of QE that we've seen over the last 5-6 years has basically thrown out the rule book, so we don't really know where we are. And Yellen pronouncing another 4 trillion potentially she's got in her back pocket. This is distorting markets to a tremendous extent. One day there's going to be a huge correction. When that's going to come, if it comes, I have no idea. But we're in uncharted territory in terms of being able to, fundamentally forecast the valuation of equities, in my opinion.
Thank you, Simon. Vivian, have you got any thoughts?
Well, I think it's very, if you go back to, pre-2008, sort of everybody was predicting things would go down. It doesn't seem to be the same at the moment. I don't think anybody, I think the market is different, and we base our advice purely, that nobody does know what's going to go up and exactly what's going to happen. And we stick to very much as I keep on saying, a very diverse portfolio to help take the guesswork out of it.
Thank you, Vivian. And Andrew, what do you think?
I mean, again, if you're looking at today, valuations are not very attractive anywhere. Relative to bonds, though, however, in terms of your expected assumption on returns, you have to think about equities. You cannot sit in fixed income and assume you're going to get positive or low or even low single-digit returns on an annualized basis. Equities are going to be the only place, even if you struggle in the short term, that you're going to derive some level of return. And so behaviorally, even though we have these debates internally, valuation models all point towards stretch valuations. Historically, at this level, you can still get they could still go further. So the models will tell you they're overvalued, but the markets will still continue, and there will at some point be a correction, but there always is, and that's a buying opportunity. Not suggesting you should be selling and putting it all into gold. Again, gold has a role in a portfolio, but it is a much smaller role relative to equities if you are a growth investor. If you are looking over the shorter term, to protect your portfolio, protect your equity component, things like high dividend paying stocks or more quality focused stocks should give you some better protection, particularly when you have potential interest rate hikes in the US, given they have generally a lower sensitivity. So that's what we think about.
Great. Yeah, that's great. Any more questions from the room? I think we've got one just at the front here and maybe one at the back. So if we take the one at the back first and then we'll come to you, sir.
Got a specific question on dividend yield. There's been a lot of bad news regarding pension deficits. How's that going to affect big companies, specifically in the FTSE 100, to pay dividends in the future?
So I guess this is a question about having a sort of diversified income portfolio specifically. Does anybody have a point of view on that? Vivian? Angie? Nobody?
It's not really.
I mean, the answer is they're going to have to cut them, right?
It's a short answer, really, isn't it? Yeah.
Yes, and I think that's where, if you think about the FTSE 100, I mean, it is in effect a global market. There might be some offsets from a currency effect, but you are going to have to be very nimble and move very quickly. If, as what I said earlier, if dividend stocks are our quality stocks at least are a place to be, they're going to become very crowded. The sort of lower volatility stocks have done very well over the last 3 years. So maybe you should be diversifying your bets between high dividend and value stocks, because while value stocks have underperformed, it might be the time now to take a 5-10 year view and offset the risk there.
Thank you. And the question we had at the front?
Mine's just a general question.
Sure.
I always hear that in a diversified portfolio, you shouldn't have too many holdings. I want to know why this is. I mean, if you've got money to invest, there's many good funds out there. There's many good ETFs, or questionable, but there are many.
Yeah.
Investment trusts. Why not have a portfolio of 100 different holdings or more? Why do they turn around and say, don't have more than 25? I can never understand this.
Well, I mean,
it's diversified,
yeah.
It's sound.
No, sure. I mean, I guess the one answer might be that it's what's manageable, but I don't know whether anybody else has got any thoughts on kind of how many holdings you might have in a diversified portfolio.
Not to get too statistical with you, but theoretically or statistically, if you run the analysis on a portfolio which contains constituents which have no correlation with each other. So let's assume this is a fully diversified portfolio. The benefit of the numbers of instruments you have in there starts to kick in at around 6. It's a sort of exponential graph that goes down like this. By about 20, you've got about as low as you can, and then you've got this big long tail which stretches out. So you can have 100, but the advantage you're going to get from adding all of that additional is very incremental at that point. But let's not forget, you're right in many ways, because what we haven't really just underscored here at this presentation is that theoretically you can reduce the risk in your portfolio to 0 if you have enough instruments and if each one of those are non-correlated. So let's never forget that. It's the only free lunch in investing, and we should all be trying to optimize our diversification fully.
So do you guys agree with that, the only free lunch in investing? Or?
I mean, it's not free. You pay for it somewhere.
Yeah.
But it is a good question, and I agree theoretically there is a historical number of stocks, but that's not factoring in forward-looking,
I'm not talking just about stocks. For example, let's say India is a good investment now. Buy an Indian investment trust or unit trust fund. There's many good ones. Why just have one? Why not have 4 or 5? I mean, it's not really any more work.
I think one thing that if you're thinking about like a traditional portfolio that I would see, mostly active funds, the problem is costs. So the costs of transacting in each fund. I mean, if you think about it, overall returns are going to be significantly lower, and we're forecasting, for a balanced portfolio between 3 and 4% before fees.
Why are they? I don't understand why they're lower.
Why market returns lower?
Well, if you've got a diversified fund with one of the big investment companies, let's say Hargreaves Lansdowne, there's many of them.
Yeah.
You're paying very little in fees.
No, you're paying a lot in fees.
Are you?
You're actually paying about 1.5%.
What, to buy them?
Yes, to buy that fund.
You are paying.
Yeah.
And to hold it on their platform.
And if I tell you that the expected return from markets, and this is BlackRock's assessment, so you can look anywhere else, is going to be between 3 and 4%. You take away those fees, you're left with very little when it comes to return.
Okay, but if you're buying 5 different ones or one, surely it's the same fee.
But it depends
same
on the fund. It
percentage.
depends on the funds. If you're investing in funds that
The amount of capital
that trade a
you've
lot,
invested.
that have a lot of fees, then that will be commensurate with your the lower return. So you've got to really think about: am I using a unit trust here that's a good manager, and am I balancing my fee budget over here by buying an ETF to offset the cost budget? And I like India, for example.
Yeah.
We've only got probably time to cover one more topic, so I might just take that on a little bit and say or ask how, if you've got a relatively modest sum at your disposal, you actually achieve diversification, which sort of speaks to a little bit to what we were just talking about there. So I don't know Vivian, if you want to pick that up, maybe if somebody came to you for financial advice and was looking.
It depends
to
what you call a modest sum.
Well,
I mean,
of course,
I think for small amounts, passives, are lower charged.
Yeah.
So that they do have their place, for smaller sums. Whereas, personally, I'm a very much, believer in actives for over 50,000. But that's totally my beliefs, and every advisor, I think, has their own.
Sure. Anybody else got thoughts on that?
I'd just like to mention there's a great website, ETF.com. Please go on, it's all free. One of their journalists, Matt Hoogan, for many years now has been running what he calls his least cost portfolio. I just want to read this out to you. It includes 6 ETFs, that's all, so the transaction costs actually are 0 because this is a product at Schwab, which is a big US brokerage company. So if you have an account with them, it's a brokerage fee. It covers US equity, developed equities, emerging markets, fixed income, commodities, and property. This portfolio covers 3,776 stocks, 1,390 bonds, 19 commodities, 40 countries, and a dozen currencies. And that's all for 9 basis points. 9 basis points, no commission. So if you've got a little money and you want a lot of exposure, that's your baby.
Andrew, any
I
final
agree.
thoughts on that?
I mean, you can buy the S&P 500 today for 7 basis points. It cost you 40 a couple of years ago. Where it's going to go, it's going to be free at some point. And I think that's great for consumers, but the challenge is you don't get the simple diversification that you used to get, so you have to be more active or rely on additional strategies that will cost you. And ultimately, if you pay peanuts, you know what you get. You do need to think about where you spend your money, how you pay for that diversification, that extra diversification, because ultimately things are going to be a lot harder in the future, particularly than they were over the last 5 to 10 years.
Great. That's all the time we have, unfortunately. So thank you very much to our panellists, and thanks for your questions. Hope that was useful. Thanks, guys. That was great. Cheers. Thank you.